Charlie Munger's ominous forecast warns of an impending financial catastrophe, unlike any witnessed before. With a track record of insightful predictions, Munger's latest proclamation points towards a collapse of unprecedented proportions in the global economy. The legendary investor's words serve as a stark reminder that our current financial trajectory may lead to uncharted turmoil. As the world grapples with mounting uncertainties, Munger's dire prediction urges us to reevaluate our economic systems and safeguards. Will his words be a wake-up call to avert disaster, or a harbinger of an unparalleled financial crisis? Everything will collapse in financial crisis we have never seen before. Charlie Munger, the vice chairman of Berkshire Hathaway and a longtime business partner of Warren Buffett, is known for his insightful perspectives on investing, finance, and economics. Munger has often been candid about his opinions and predictions, and his thoughts on the potential for a severe financial crisis have garnered attention. Charlie Munger expressed his deep concerns regarding the potential for another fiscal crisis in the United States. Munger specifically drew attention to a worrisome situation involving commercial property loans held by American banks. Many of these loans could be classified as bad loans due to the decline in property values. This assessment led him to foresee a bleak future for the American commercial property market, with a significant portion of real estate facing challenges. Numerous office buildings, shopping centers, and other properties are currently struggling, revealing a landscape fraught with difficulties. The pursuit of acquiring more value than what is paid, an essence that defines successful investment. This principle is timeless and never becomes obsolete. This prudent approach, with a growing trend in which a segment of market participants lacks a true understanding of their investments, merely regurgitating ticker symbols and quotes, drawing historical examples like the South Seas bubble and the 1920s stock market crash, illustrates the cyclical nature of speculative market booms and their subsequent fallout. Such phenomena have been intrinsic to capitalism since its inception, with these crazy bubbles recurring over time. Munger's insight extends to the perception of the current stock market landscape. The stock market has transformed into a speculative casino, where elements of gambling outweigh the rational investment. In numerous instances, market behavior has detached from the fundamental values of underlying stocks. This disconnect is what lays the groundwork for the formation of bubbles that inevitably burst, resulting in market downturns. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible life-changing content. Now, let's move on. Lessons from Latin America and Plato on money printing and democracy. Looking at the unprecedented scale of money printing undertaken by modern nations like Japan, the United States, and Europe, large-scale money printing has entered new territory in terms of its magnitude. Despite the extreme measures taken by governments to inject money into their economies, the dire consequences that some might expect have not materialized. For instance, Japan's experience of decades of economic stasis can be attributed to increased competition from China and Korea in their export sector. Surprisingly, Japan has managed to maintain its civility and admirable qualities, despite its extensive money printing efforts. However, Japan's societal structure may be better suited to endure periods of economic stasis than that of other nations. While Japan has seemingly weathered the storm, other nations have faced severe consequences when they push the boundaries of money printing too far. And the United States might be moving closer to a point where the consequences of uncontrolled money printing could become problematic. In the era when Paul Volcker raised the prime rate to 20% and the government paid 15% on its bonds to curb inflation, challenges and hardships accompanied that period. The forthcoming economic challenges might be even more difficult to address and remedy. Consider the historical patterns evident in various Latin American countries. where the excessive printing of money has led to the rise of authoritarian figures. This phenomenon resonates with Plato's observations on the early Greek city-state democracies, wherein a democracy set up with one person and one vote often results in a proliferation of demagogues. These demagogues manipulate the populace, ultimately eroding the foundations of democracy. Plato's assessment, which pinpointed the same dynamics in ancient Greece and subsequently in Latin America, is not to be dismissed as far-fetched. Rather, it accurately depicts the recurring cycle of events. The objective, of course, is to avoid falling into similar pitfalls. Frequently, the distress caused by inflation paves the way for leaders who promise to rescue the population from its economic woes and restore prosperity. Paradoxically, this route often acts as a gateway to dictatorial rule. The situation being faced currently is an extreme one, with uncertainties surrounding the severity of the consequences. Whether the outcome mirrors Japan's experience or something considerably more dire remains uncertain. The intriguing aspect lies in the unpredictability of the situation's resolution. While it's acknowledged that serious trouble is looming, it's also recognized that some of the initial apprehensions may have been exaggerated. Japan's continued existence as a civilized nation, despite unprecedented levels of money printing, stands as evidence. The allure of easy monetary policy is illuminated by its seductive nature. The scenario involves clearing interest-bearing debts with non-interest-bearing checking accounts, thus eliminating interest payments while expanding the money supply. This appears almost utopian, particularly to legislators seeking solutions. However, this seductive premise often leads to its excessive usage, creating a situation wherein government spending exploits the leniency of monetary policy to generate easy debt without a proportional increase in taxation. It's here that Munger raises a crucial red flag. The core issues of easy monetary policy lies in its tendency to loosen the reins of fiscal responsibility for governments. The comparison between Latin American nations and Plato's descriptions of early Greek democracies underscores the precarious nature of excessive money printing. The potential for inflation-induced leadership shifts and the subsequent erosion of democracy is highlighted, prompting a cautious approach. Meanwhile, the temptation of easy monetary policy's benefits is juxtaposed with its inherent risks of facilitating unchecked government spending. In navigating these complex dynamics, the overarching theme remains one of vigilance to avoid historical pitfalls, while managing the multifaceted consequences of monetary decisions. Charlie Munger predicts crash. The idea of eliminating debt by providing someone with an account that doesn't earn any interest might seem like a simple solution. However, not only are we facing serious problems, but the easiest solution for politicians and the Federal Reserve is to print more money, which might seem like a quick fix for immediate issues. But this approach can lead to dangerous consequences in the long run. We have seen historical examples, like Germany's Weimar Republic, where continuous money printing led to a catastrophic outcome. All of these matters are risky and should be taken seriously. It's not advisable to have politicians opting for what's convenient and repeating the process, thinking that since it didn't harm us the last time, we can double down and do it again. The pattern of constantly doubling can eventually lead to a very different type of government if continued unchecked. So, there's a certain level of danger we're dealing with, unless there's some restraint in the process. However, it's worth noting that we don't see Japan as being in grave danger. They've engaged in extensive money printing and managed to cope. But can the U.S. handle problems as effectively as Japan has? When it comes to government spending and debt, if there are no consequences, it can lead to a cycle of more of the same for political gain. The United States differs significantly from Japan, and the outcome of our continuous national debt and printing of money could be quite different. Over the last century, the U.S. has been a major driver of global economic growth, making the potential consequences potentially worldwide. There are substantial political risks when a government destroys the purchasing power of the currency, earning potential, and the value of savings. In a Western country, there's a risk of a strong leader coming to power promising to solve economic issues and gaining support while attempting to do so. These predictions extend beyond a mere stock market crash and delve into the dangers of an economic collapse and the potential for political instability. Charlie Munger, currency going to zero. Think about the Roman Republic, which was a very long time ago. They kept increasing the amount of money in circulation, the stuff they used to buy things. They did this for many years, and eventually their whole empire fell apart. This happened partly because of the money losing its value. This idea of money losing its value is called inflation. It's like when prices go up over time and you need more money to buy the same things. Inflation is a big problem that can happen over a long time, and it's one of the most serious dangers we face, aside from really big problems like nuclear war. Imagine you're an investor, someone who puts their money in different places to make more money. If you're thinking about the next 100 years, it's probably safe to guess that the money we use today will be worth very little in the future. This is what Munger is saying when he predicts that the US dollar, the money we use, might become almost worthless over the next 100 years. If you find this video informative, like and subscribe to this channel for more educative content. Let's continue. This might sound strange, but it's not that crazy. If we look at history, the value of the US dollar has gone down a lot since they made the Federal Reserve, a group that helps manage money. Over the years, the US dollar has lost more than 96% of its value. Even more recently, since 1971, when the US stopped using the gold standard, the dollar has lost 86% of its value. So based on what's happened before, Munger's prediction isn't that surprising. This prediction is a warning, a way to get our attention about the big problem of inflation. It's a reminder that if we just keep our money without investing it, its value can go down a lot over time. Munger is worried about inflation causing not only problems with money, but also political troubles. There's a lot to think about when it comes to this topic. So, what can you do about it? When considering the potential long-term effects of inflation on your savings, your best bet is to invest your money. Firstly, diversify your investments across different types of assets, like stocks, real estate, and precious metals, as these tend to counteract the erosion of purchasing power caused by inflation. Additionally, focus on productive assets that generate income, such as dividend-paying stocks and rental properties, to stay ahead of rising prices. Regularly reviewing and adjusting your investment portfolio based on changing market conditions is essential, and seeking guidance from financial advisors can help tailor a strategy that aligns with your goals and risk tolerance. While safeguarding against inflation is crucial, your investment approach should also account for your broader financial objectives, risk tolerance, and the advice of professionals. By combining these strategies, you can work to minimize the impact of inflation on your financial future. Charlie Munger's insights into the potential for an unprecedented financial crisis serve as a sobering reminder of the complexities and risks inherent in the global economic landscape. His concerns about the consequences of extensive money printing, inflation, and the potential for political instability underscore the need for careful consideration and proactive planning. While the future remains uncertain, Munger's perspective encourages us to remain vigilant, diversify investments, and seek informed advice to navigate the challenges that lie ahead. If you enjoyed this video, don't forget to like, share, and subscribe to this channel for more growth content. Thanks for watching.